This is the weekly economic and market update for the week ending September 21st, 2022. And I look forward to the week of September 24th, 2022. And I like to call what happened, at least today, Friday, the 21st of September, buy the rumor, sell the news. So there was a rumor today that the Fed is going to back off the increase of the federal funds rate. And so markets were up big today, and it was caused by that. Now, what this actually winds up being, I'm curious to see how the Fed responds in some of their future communications. They're still on schedule for a 3/4 of a point increase in the federal funds rate for the beginning of November. But things are getting a little shaky out there in the financial arena. So it wouldn't surprise me if the pause, I wouldn't say the pivot, but at least a pause, a slowdown, something happened. And I think the markets are actually looking for a reason to move up. And there's a lot of skepticism with that, which we'll see here in just a second. One other note, I thought this was interesting. Peter Schiff, in his podcast and also on his Twitter account, basically made notice of the fact that by next year we'll have 35 trillion. We're standing at 31 trillion today in national debt in the U.S., and that $35 trillion will be the new number. And I believe our current president is trying to outdo President Trump in the amount of spending they did, although more of it was for COVID, I would say, in the Trump arena. And we spend away and then we raise federal funds rate, but I won't harp on that. But anyway, the 35 trillion in national debt is greater than, now get this is really blew me away, than the national defense budget, welfare, and education combined. Think about that. And what do we get for interest? Nothing. It's something we pay out, and we don't get any benefit from it at all. So that's where we stand, and our current administration continues to spend money and ignore the fact that allowing energy production in the U.S. to fulfill the world demand would both reduce inflation and also help out our allies in Europe that are being hit hard by the Russian oil embargo. But, green is important. So even though we're going to have oil for the next 20 to 30 years, and we don't have the infrastructure and so on and so forth. Okay, so let's look at the investor sentiment this week. It's at 56.2%. It's up a little bit from the week before. Who knows what it'd be after today, after the big increase. Everything is dependent, day-to-day dependent. And that's still 56.2%. It's pretty, still very high. And, it's not as high as the record of 70%, but it's close to the second highest bearish sentiment we've had at 60.9%. So that's, where everybody is. I'm a contrarian investor. And I look for the fact that, it's not a fact, but I look for this type of sentiment for a turnaround because there are a lot of puts out there, and they may get squeezed. We'll see what happens here in the coming weeks. All right. And remember, I play it both ways with the tools I'm using in straddles and strangles and things of that sort. All right. Fear and greed index. It actually moved up this week quite a bit. It was a week ago, it was 21, and today it stands at 45, which makes it neutral. And I think this is all based off of the fact the a rumor that the Fed was going to be backing off the pace, and it moved a lot today. Um, and I would expect that if we get more like that, we'll continue to see the fear and greed index move up. But we're not out of the woods yet. I still have some expectation that we'll have a massive bear market rally that may turn into a bull, and then the bottom following out. That's kind of my pendulum that I've talked about in previous episodes. Or weekly updates. So you can go back and listen to those, especially at the beginning when I first started this a couple months ago. What else do we have? We got the 10-year Treasury note, which just has been on a tear, which is one of the wrecking balls that we have out there. With the 10-year Treasury so high, it's a key indicator. If you can see this week, we started at 4%, which is still pretty elevated, and peaked out, upper 4.3, a little over 4.3%. I mean, these are really high rates that we haven't seen for quite a while. Just look, even year to date, we look at it, it's like a big, looks like a ski slope, going down here. With some moguls. Anyway, so that is not good news. We need to see that turn around if we're going to see any rally in the markets. If you're a bear, you're probably loving it. The spread is pretty good. Something's got to give on these numbers. We look at the economic calendar for that happened this past week. A few things I'll note. One of the things I want to make note of, since it was kind of the housing week for data, is the 30-year mortgage. Let's look. 10 is right up there, close to 7%, 6.94%. Release it, and so we went from, in essence, 3 or a little under 3%, but around 3%, all the way up to just about 7%, and that's gonna that's gonna do some damage to the housing market. 3 to 7%. I mean, that the payments are going to increase quite a bit based on that. So let's take a look at some of the numbers then that were released this past week. We can get to that. And the housing starts, actually, it's down from the last report in August, or the August numbers, but it's held up fairly well. I was expecting it maybe even to get below that 1377 number from July. So it's not great. It's certainly not as good as it has been in the past, but it's not awful. Let's look how it compares. Yeah, we're starting to, you can see it's starting to make its way back down. We'll be following that for sure. And building permits, another kind of key indicator, we're actually up a little bit, although we dropped from 1.542 million down to, from 1.685 and was up just a little bit this week. I think it's still working its way back down. We saw the interest rates, building permits. You'll probably see cancellations and things of that sort. And let's see what else we have here. How's existing home sales? Another one. It's just kind of slowly making its way down. 4.71 million was in line with what they were expecting, but you can see it's just it's slowly sinking down, and as interest rates go up, that will also, if they continue to. If the 4 year or the 10-year yield that we just looked at, doesn't begin to turn around, then obviously these rates will go up. I think long term they'll continue to go up. I think we might, if we do get a turnaround, it'll be short term. We get our deflationary bust that I think will be brief in nature, but is what I am still in line a bit with Dave the Contrarian Hunter, and the expectation is that I still will get. I don't know whether we'll get to all-time highs, but I do expect kind of a wild bear market rally, and it could turn into something that everybody jumps into and drives it higher to all-time highs. Don't know. He's certainly in the minority. It just the whole sentiment thing for me is what drives my thinking to something different's going to happen. Now, David Hunter, he'll rely on the 40-year cycles and a number of other secret sauce things that he doesn't reveal. But we'll see what happens. Talked about the 30-year mortgage rate. Let's go back to the calendar and look at what's happening this next week. So new home sales, they'll be reporting on this week. The expectation is it'll be something less than it was in August of 685,000. Looks like around 590,000 is their expectation. And let's see what else we have coming up. We got durable goods orders with the expectation that it will be up 0.5%, where it's been down the last couple of reports. And the GDP growth rate. Now, this will be interesting. It's saying 2.1. I mean, we've had some mixed figures. Maybe, that's possible. I saw it really low before, but I think this is going to be short-lived. If it is a 2.1% read, and it could get downgraded over time. And one of the other things, it's interesting what they consider to be important. I mean, we've got personal income here and personal spending, which certainly are going to be market driven things, but the primary thing is going to be these PCE numbers. Now, remember, it's Jay Powell that basically said, the Fed chairman said that he pays more attention to the PCE index than he does the CPI. So to me, this should be in red. I mean, if it comes out something different than what the CPI had reported. Now they usually move pretty well together, but that was a couple of weeks ago that the CPI was reported, and there's not necessarily any consensus, but anything below 6.2, and certainly anything in the fives for this number, on the annual change, will probably drive the markets up. And let's see, month over month, yeah. So we'll take a look at that. I think it's an important number for people to look at, but most of these other things are housing related, and we'll just have to see some of the economic activity on manufacturing. I may do another report on that next week. So anyway, that is a look at this past week and also this coming week of September 24th. And, we still are in the mode of relying on the Fed for what's going to drive the next thing, which is just a really bad place to be. Especially when they're using lagging measures and, they're reacting other than that. to some of the conditions around them, not only in other countries, but some of the craziness that we have going on within. And again, it just doesn't make sense that we're spending like we are, letting government spending, why folks out there think that, you know, we can just spend, and then they blame it on companies for price gouging. I did a video on that off of Senator Warren's price gouging video that she did, if you want to check that out. So anyway, that's this week, and remember, there is always a better way.